with Tom Williams. Hello to Tina. We had a little message here. Hello, Tom, from Tina. Hello, and hello to Jamie. Hello. Good. So you can hear us, okay? Good. So that was our quick sound check. And hello to Colin as well. Great. Okay, I'm going to now. Hello, Grigory. Going to pass over the headset to Tom. Tom, Jamie says nice move in gold today, so maybe we'll have a look at that later on. Mind you, Tom says, was it up or down, Jamie? Big down, he says. Of course, we don't have the data though, do we? Do we have the intraday? Well, we've got end of day, so we'll have a look later on. Okay, Tom Williams about to speak.
Right, thank you, Rita. Yeah, hi everybody, Tom Williams here, speaking to you as usual from Worthing, Sussex, England. And the weather is getting warmer, thank goodness. It's all very well, but it's cold, I'm not used to it. Okay, now, what have we got up on the screen? Right, this is the S&P 500 cash market, but it's only the end of day chart. So it's up to date for yesterday, Thursday. Now there are times in this index where the indications are so clear that you can't really make a mistake. And there's two instances on this chart that would fall into that category. Now the first one, of course, is yesterday. Right? Whenever you see the market has rallied up, right? It's been going up for ages. In other words, it's been trending up. It's hit the top trend line and the spread is narrow, right? And the volume, well, it can be low, but it can be high as well. This is what confuses a lot of people, because they don't realize the underlying principles that we're looking at. But it's producing automatic signals. Selling pressure. Right, so read the dialog boxes. But whenever you see that after a rally, right, you can bet your bottom dollar that that's a serious sign of weakness. And you at least expect the market to fall next day, which it has. But we'll look at that in a moment. So that's typical. If the volume had been ultra high, right, and perhaps it had even gone up a bit higher, gapped up hopefully, that would be the end of a rising market. But we don't actually see that. But this is close to what is required to produce a signal in the computer, right, telling us it's the end of a rising market. But that's definitely weakness. Definitely weakness. Now, I don't know what the news was. It was probably good. Who knows? I don't listen to the news unless it's sort of, I listen to it accidentally. I don't know. Now, so that is a very, very clear sign of weakness. Now, you should study that carefully and embed that in your mind, because you're going to see that many, many times during your lifetime, because this is how the markets work. It works on supply and demand from a professional side of the market. And when we talk about professional players, we're talking about professionals that will throw in 5,000, 6,000 contracts, and others follow as well. So you'll see that many, many times during your lifetime. Now that rule, that particular rule, was probably written 15, 20 years ago even, when I was just sort of like looking at it from an amateur point of view. Right? It's still there. It'll still be working in another 50 years' time.
Sorry, Tom. Carlos had just asked for us to show where the trend channels.
Oh, that's all right.
That's why we were fiddling around.
Okay. Well, we'll look at the trend lines properly in a minute. Right. Now, the next very, very obvious one we picked up last Friday week was this shakeout here. Here. Right. It's in all the indexes. Right. It's been marked, heavily marked down. Right. The volume is not, there's a little bit of volume there, but it's not excessive. Right. That's a shakeout. And it's a shakeout because it's been violently marked down. Right. Closed near the high, relatively speaking. And of course, next bar responds up to that. But that's a shakeout. And that's what's been making this S&P 500. Every time it runs out of steam, they have this shakeout. And that gives it another jerk up look. Now, somebody queried the trend lines. Peter?
Hello, it's Peter here. So Carlos was asking to see a longer term view, which we can show, and let's put 150 bars up. And these trend lines are drawn in a certain way. So when it's trending up, is it the first 2 points of support with an intersecting or intervening supply or high? So there was the first point here, there was a second point, and then the intervening or intersecting point is on that bar there, because that's a high, and then the parallel lines go up, and hence we've got that trend channel. And I think, Tom, was it fair to say that's a Wyckoff method? That's the way Wyckoff did it, Tom says. So any questions on that, anybody, including Carlos?
And they're stored in the computer to give you, what are those? I never use them.
Oh, yeah. Trend clusters.
Trend clusters.
Oh yeah, there's something else called a trend cluster, which I don't know if was it part of Wyckoff, not particularly, or was it?
No, it's only possible because of computers.
Yeah, so a trend cluster, I don't know if we can show them here. We don't usually talk about them particularly. There we are, trend cluster. There's quite a few there. A trend cluster is an area which in the past, which could have been more recently or quite a while ago, is a level that may have popped up several times. And so when that happens, the computer can look back on the data and say, well, we've reached this point before once or twice or however many times. I'm just going to make it slightly less sensitive because we've got quite a lot there. Let's remove some of them. Tom, you've mentioned a few times about trend clusters over the years. Do you want to say something about how they appear?
Well, you can only really do this via computer. Those clusters show you where in the past trend lines have crossed over, and that's built in, obviously, in the memory of the computer. And you would expect that trend line, those clusters, to have some detrimental effect when the data reaches them. If the data doesn't reach them, obviously just ignore them. No, hang on. But they're very interesting, and I'm sure you've looked at them.
This is a good area to show.
You want to talk freezer? Yeah, go on.
Yes, you can use it. I don't use them, but I have had looked at them in the past, and actually they're quite interesting and useful. If you specifically also watching your trade, when you're in a trade, you watch how this is a fine example how they have an influence upon the market. So this trend cluster has produced almost like a sort of level of support. And see how it's come along. And often any time frame you can see when you get a little, I wish that thing wouldn't, that's it. When you get a gap between them, often it will break down through it or up it and then keep going on. So they do have some kind of influence, and some people use them and other people don't.
Yeah, but you make us it's well worth looking at, studying, because sometimes it's uncanny how you'll get a trend cluster area and the market hesitates. Then as soon as it sees a gap, it shoots up through it. Now, why that works, I don't know, to be quite honest. All I know is trend clusters work because when I was in the syndicate, we used to use it, but we had to do it all by hand. That's why I had this long industrial ruler and a big flat table, and you draw the trend lines way out on the graph charting paper into the future. And sure enough, usually when the data reaches, if the data reaches them, then something will happen. Now, why trend lines work, if somebody knows, please tell me. Or I don't bother my head with wasting my, well, I'm not wasting my time, but looking at all this stuff. All I know is the markets move on supply and demand. And we can prove that to you because of the automatic signals. And the computer does not understand flaws in your thinking, flaws in your logic, flaws in your understanding how the market works, just doesn't want to know. And if you think the signals are fairly good, or I call them uncannily accurate, right, then if you view them like that, then what we're telling you is what we built into the program via program, of course. Now, I know I could improve this program a lot, but I don't have access to a programmer, believe it or not. Gavin's in charge of that. He's gone away out doing different things, but they are. But you could still learn to read these charts and see them. And once you understand and learn them, you can read any chart. And it's very fascinating and well worth it because you have this skill with you for the rest of your life. And once you're into it, you just can't give it up. You won't give it up. So it's very exciting. Question?
Yeah. Shall I take the...
Yeah.
Yeah. Carlos is saying maybe channels work because the smart money, like the one Tom used to work for, use them. And yes, and not just the smart money. I think a lot of people trade using trend channels. Robert is asking, how about the upper line of this trend channel? Does it need to be adjusted as the new highs show up, or perhaps it remains as it is and the breakouts are treated as false breakouts?
Yes. You don't alter the trend lines because if the market goes up through them, then of course you're overbought. Once your data is over the top of that trend line, you are definitely vulnerable to weakness, and the reason is you're overbought. Same if it drops below the support line, then of course you're oversold. And it's usually an opportunity for traders to enter the market with some safety. Okay, so that's trend clusters. Now, admittedly, I don't use them very much, and that's just my preference because I can read the bars well enough not to really want anything else or need anything else. I mean, yesterday I'll tell you immediately that market would probably highly likely come off today, and which it has apparently. But so you don't need clusters, you don't need any other information at all. It's there in front of you, look. If you embed that in your mind, but if you ever see that like that in the future, but even possibly gapped up on good news something fantastic's happened. And if the volume is very, very high, then that's a guaranteed top. And you should have a signal called the end of a rising market. And that will not disappear. That will mark the top of the market. So it's very interesting. Now, is there any questions about that before we move on to something else? Move on to the hour, Peter. Right, now this is a current future, right, responding to that daily chart. Now, of course, it fell. There's the top there. Yesterday, yeah, that would be right. So you can more or less see that weakness, definitely. This blue bar has to be on no demand, look, which it is. Right, this would be on no demand. And so it came off. Don't forget, the market is not there to help you. So if you get a sign of weakness, don't expect it immediately fall. It won't. They want to whipsaw you. Because they want to try to, well, they do, try to show you that you're not right, you're wrong. You're not so clever as you think you are. And so they whipsaw the market around. But anyway, that's come off, look, because of that signal we saw last night on the end of the daily action. Right, so this is a current. What's it an hour, Peter? Is it?
Yes.
Right. So we've got seems to have loads of signals here. But that's on up bar.
Bottom reversal, it says.
Yeah, well, that's a bottom reversal. Because whenever you get a widespread down like that, on that high volume, there must have been some support there, especially if the market closed on the top of the bottom quarter, look. And next bar's up, vigorously up, and a widespread up. That's a bottom reversal. That's normally a sign of strength is entering the market. And you've got this where the volume first appeared, or no supply there, sorry, here. Right, so what you do now, you think, right, there is a possibility of an up move here, especially since it's Friday. They like to close on the high if possible, so that all that propaganda can come out. Now, Rita says there was some news at 5:30. Yeah. Now, I don't listen to news, but it's interesting. No. Nothing outrageous happened on that news. But you've got to be wary of news. The news is not there to help you. The news is there. You'd be very, very naive to think that the professional floor traders were not fully informed of what the Federal Reserve was going to say at 5:30. You'd be very, very naive if you thought that was a secret. They probably knew about that several days ago, exactly what was going to be said. And what they do, if they can, they'll whipsaw the market on that news to obviously destroy as many, shake as many people out as possible, traders out, and better their own accounts, which is normal human behavior, I'm afraid. So what time frame is this, Peter? 1 hour. Oh, sorry. So this is an hour long.
Tom, somebody asked what time we're here locally. So we're GMT +1. Yeah, hello, it's Peter here again. So somebody asked, who was it, Rita? Menno asked what time we're operating on here. So of course we're in the UK, in case you didn't know, and the timing on the screen here for the bars is GMT plus one, in other words, British summertime. But if you look on your computer and look for GMT, we're GMT plus one.
Yeah, sounds a bit like army time, doesn't it? I don't, but all I want you to know is that you've got to be careful, because there's nobody in the stock market, right, especially the exchange themselves, anybody's going to help you. They're not there to help you, right? They'll help their members, perhaps, but they won't help you. Okay, so you've got to ask yourself a question. Why are they so keen, or apparently helpful, by telling you when all these news events are going to appear? So you assume that the market is being moved on this news, or the news moves the market, which is totally incorrect. So you've got to be armed with that, right? And the reason they want you to listen to the news is because they know it's a great way to get you going in the wrong way, catch your stops, do all the damage they can, and out of that make money from you. They're certainly not there to help you. And that goes for newspapers, magazines, and any other sources. So you've got to really, you're out there on your own. But most people don't realize that, although it may be quite common to you because you listen to us all the time. But there's some very, very naive people out there. And so be careful with news. Okay, so, right, what have we got? So the market's come off because of that weakness we saw, right? That's a nut bar. Doesn't look very helpful, does it? Sticking up in the air, and it's closed almost in the middle. Look, there's even a signal there. Supply coming in. So you wouldn't expect high prices immediately after that. So they plummet it down. Right, there's still high volume appeared. So that we know that there's supply in this market at the moment. But there could easily be some buying in there. Right, because it's closed well off the lows. Right, and the market's vulnerable because we've seen this downfall. Next bar's up, which also helps with that conclusion. But look at the low volume, the no demand really on that. So what you would expect, if you play it safe, don't do anything until you see what we call a setup, which may or may not appear. But a setup is it'll go sideways like this for a bit. Then it'll fall back down into this level here, where we saw this high volume. And the volume, if it's low, it means that the professionals have absorbed any of the supply that's around, apparently with this high volume, look, high activity. Then you're going to go up, which is quite possible for a Friday. But it's such a tricky place to be, trading this. Don't do anything unless you understand what you're seeing and you've got a clear setup. And that is one of the setups. Questions?
Jerry's been waiting a long time with his question. Tom, how many confirmation principles do you wait for before getting into a trade? I have a habit of getting into a trade too early. Perhaps I should wait for more confirmation before getting in.
Well, I would say that's correct. You can easily get sucked into the market. You can easily get carried away and say, oh, look at that, stopping volume, ooh, right? But if you understand what they have to do before they can take it up, it'll probably keep you in longer. If you see stopping volume, right, which is normally the first sign that they've stepped into the market. You'd expect the market to be up next bar, yes, but then it may go up another 2-3 bars and start going sideways. You may even get a red arrow with no demand because they want to test that volume that you saw, which we call stopping volume. Then if the market drops back down into that level, right, and the volume is low, then it means the supply has disappeared. Now there is a bit more sophistication you can add to that. All right, if you look at the KG chart that goes with this program, be very wary about going long, right, if the bars are red, because it shows you're working on bearish volume. And therefore, what might be a setup if the market's bullish, I noticed, is not so healthy as you might think. If the KG charts show red bars, which means the volume is bearish volume. Right, so don't forget the KG chart's very important. Bullish volume is expanding volume on up bars, while decreasing on down bars. Right, that's why you get testing. No, that's bullish. Yeah, that's all right, Peter. Nobody's perfect. Far from, yeah. Now, bearish volume, you'll suddenly see the volume switch, and it suddenly becomes greater on down bars and lower on up bars, and that's why you get no demand and up thrust, all this sort of thing. But that's very important because that's the fundamental reason why this market's going up and down. It has to do that because it follows bullish or bearish volume. But once you get your head around this, you automatically see all that. And it's a great, great help, believe me.
Yes, and Craig says, what is Tom's favourite setup, if any? Well, Tom, am I right in thinking that setup you just described, where the volume is one of them, is when the volume is very high, here, sign of buying, when the market goes up, comes back down, tests it on very low volume or lower volume at that level. And of course there's the opposite in a bearish market where you get a very high, like here we are, yeah, there's very high volume, and then the market goes back up to that level on low volume as compared to that. And of course the other one Tom likes is the up thrust. It's quite a reliable one. It's very reliable after weakness, like very high volume on an up bar before. So an up thrust after weakness. I've seen some up thrusts in the past week or so, or we have, and the market's still gone up. Well, the reason is because there was strength in the background, i.e. very high volume on a down bar. So bearing in mind also that the daily chart is trending up. So always keep that in mind. And we've noticed that if we've seen anything like any sign of weakness or an up thrust, it doesn't often lasted very long because the market has been bullish. Hang on a minute. Right, another question. Stopping volume, does that mean the market is still weak? Stopping volume is on a down bar, like here, it's strength. Stopping volume is potential strength. You need to see that tested, as Tom said, so you get this very big volume, possible stopping volume, and the market ideally want the market to come down and test on very low volume to show that that volume has now dried up. That's the answer to that one, Ming. Right, Leonard is asking a question here. Can you please explain how to buy on down bars and sell on up bars when waiting for the next bar to be a down bar in order to confirm weakness, and waiting for the next bar to be an up bar in order to confirm strength? On which signs of strength or signs of weakness do you enter the market immediately after the bar closes without waiting for the next bar to confirm? Do you get that, Tom?
Well, you can't have hard and fast rules for that to answer that question. The thing is, on that daily chart of yesterday, you could clearly see it's been marked up. It's over bought, right? It's up above there. The spread is obviously narrow, right? Now that, and you've got, that's it, and you've got an up move behind you, which makes you vulnerable anyway, right? Now, you know that with a signal clear as that, you know the next bar is going to be at least down initially, and the market started to fall. If you went Globex, that went down immediately after that. All I can say is, once you learn to read the charts and you get so familiar with them, right, your skill as a trader will definitely kick in, and you'll start to see what's necessary automatically, and you won't have that problem. We don't use formulas, we don't use rules, we don't use patterns at all. So there's no hard and fast reason why you should say I'm going long here or short there. With your knowledge of reading the charts, like that last bar yesterday, you know that's a sign of weakness, and you can short that. And even if you happen to be wrong, which is interesting, right, you won't be very wrong. You won't get wiped out because that's serious weakness there. And so that's, in other words, you live to trade another day. That makes sense?
Okay. Right. Okay. Yes. So there was a question about confirmation and trading on bars of confirmation. Jamie says, wait for a change in the behavior of the market first and then go in on a VSA principle. And that's what I would do. Yes, Jamie, that's right. There's a question here from Ming, which is quite a good one. With a reversal bar, shall we try and find a reversal? Yeah, well, yeah, either. With the reversal bar, is the volume on the second bar important, whether it's high or low? So I'll take, you get that, Tom?
Well, market conditions do vary, but the bottom reversal with the first bars down with a fairly wide spread close near the low, possibly on some bad news or so-called bad news, but despite that, the next bar reverses, goes straight up and closes near the high. If the previous bar was down into a fresh low ground, right, why should the next bar be up if the market's not fairly strong? That's all I can say to you, really. Sometimes the volume can be low, right, and it can be, usually, I suppose the ideal volume is average or near the average.
There's lots of people asking about it. We're just putting up the KG chart of the S&P 500. So Carlos has requested that. That's green. Okay, so 2 questions on KG charts, Tom. Jack asks, does the KG chart work in different time frames, please? It doesn't, does it? It does. Yeah, it does. But we don't have that facility. We only have the KG chart facility on the end of day chart. So he says, yeah, or is it just bullish or bearish for a period of time? That's the first question. And then if we see an up bar in a narrow range with high volume in the KG chart, does it mean supply coming in like a bar chart?
Yes.
Do I just say yes to that? And the answer to that is yes, says Tom. That's, right, Menno, can you go back to the... Yeah, so Menno is asking, the bar of Tuesday, what's the difference with that compared to Thursday? So that Thursday was, yeah. All right, so Menno is saying really that this Tuesday bar is very similar to the Thursday bar. What is the difference? Why, I suppose, have we got ourselves a signal on Thursday and not on Tuesday, Tom? Because they're both very similar, he says.
Right, so that's Tuesday, you say? Oh, Tuesday, Wednesday. And there's similar bars, you're saying?
I'm saying that the bar for yesterday, Thursday, it's the narrowest spread.
Yes.
Now this bar on the Tuesday is also the narrowest bar close to the middle.
Ah. Well, there's a huge difference there. Right. First one is you've got this shakeout right behind you. Right? Don't forget the background. Whatever the market's doing at the moment is strictly the result of what's happened in the background. It's something like your own life. Whatever you're doing now, right, is the reason for something you've done in your background. Right, so you've got this shakeout here. So the market's responded to that. Look up, and even that could be looked at as a bit of a test. Now here, of course, the volume is not particularly average, right? But don't forget, you're looking at 500 stocks here, right? And you've got this high here. Now that shakeout there was an obvious attempt to drive this market up through this high here, because that's the resistance level, right? And there it is gapping up through there, pushing up. So basically, you've got to be a little bit careful here, because that could be construed as being bullish. And if they test this level back here, and it comes down, the volume is really low, then it could easily go back on up. Easily. Make sense?
So Carlos is asking for the futures KG chart. We don't have that facility. We can't put a KG chart on a future chart. It's a limitation of our real-time program. So he's saying, please show the future KG or the SPY, etc. We won't do any future chart unless we go have a look at the SPY. Some of us are very frustrated with the KG chart since it looks totally different on NinjaTrader. So I want to compare the future contract or the SPY to see if there is any difference we are showing, which is not the same. So we're just having a look. No. Right. So we can't. All right. I'm sorry about that. We can't. Right. Shall we have a... Oh, are you doing... Are you... we're just adding a... Okay. Just having a go, see if we can... Because this actually question has come up quite a few times now, hasn't it, on our webinar. We're just getting ready. Sorry, we're still here. What? We have. End of day. So if we put the kg. So, no, I wasn't listening because I was typing someone a message.
Okay, so we've got the SPY, SPY, on the screen here, and the kg of it. It's the end of day, and as one might expect, it looks very similar to the index. Is there anything you want to say about this chart, Tom?
Well,
Does this help Jerry? Ask Jerry. Does this help Jerry? Carlos? Does this help him?
well, it looks to me that this is acting a bit bullish, isn't it? Look, expanding volume on up bars while decreasing on down bars.
Yes, same.
More or less the same as the other one. So we've got to be a bit cagey here. Cagey, look at this. But if you to make a study of this in the background, right, where it has gone red, and see, you know, how the volume will portray, be either bullish or bearish volume, at least it helps you, warns you, to make sure that at least you're heading in the right direction, perhaps. But these changes of signal can come up so suddenly, and they suddenly appear. You may even be long and think, oh, I'm quite happy with this. I've made a bit of money. Look, oh, hell, there's a sign of weakness. I'll probably ignore that. Probably won't be right. And, of course, usually they are. And that's, you know, so you've got to watch that.
Question on this one. Edmund is asking, starting on the red bar in the middle, why the up bar is higher than the down bar and the kg chart shows in red colour.
As soon as the kg chart's showing red, it must be showing bearish volume. And they will have bearish volume when they attempt to shake the market out or do something like that. The red shows that the volume is increasing on down bars and decreasing on the up bars. And as soon as it switches, which it can do very, very quickly, right, suddenly switches to volume increasing on up bars and decreasing on down bars, saying, look, that's okay, we're now bullish. So, but you'll get your head around it if you keep using it. There's far, far more help there for you than anywhere else I know. Far more.
Ming is asking, does the kg chart indicate your entry point for the market? And Thomas, no, says Tom. You need to be looking closer at the normal chart for that. But the kg chart gives you an overall idea about the market being bullish or bearish.
Yeah, so Tom's mentioned already today that Wyckoff said that bearish volume is when you have increasing volume on a down bar and decreasing on an up bar, and then the reverse for bullish volume. So in this particular instance here, you could look at this arrangement here. You can see you have a down bar, if that's what you want to call it. It's not truly a down bar, is it? It's a kg chart. But you can see on that downward stroke, the volume is less. So if the volume is less on a downward stroke, that could illustrate that the market could now be be becoming or thinking of becoming bullish. Bear that in mind. Likewise, the next move is up as far as this chart's concerned. The volume has increased, so that again, that's bullish volume. Next one is a down sweep and the volume is decreased, it's low. Again, that's bullish. Now the result of that, so we go on like that all through these charts, is that then up goes the price. So as Tom's pointed out though, in response to a question, can you trade off these? Well, some might suggest you can, but Tom's saying no. I mean, you're better off looking at the actual chart and using KG, if you've got access to it, or Cargi, however it's pronounced, as a further guide. Perhaps you look at that chart in front of you too and think, well, actually, it's showing that there's bullish volume there. So I don't want to rush and go in and be short, surely. That's the gist of it, Tom, is that right?
That's very good, Peter. The whole idea really of the KG is to show you when the market is portraying bullish or bearish volume, right? And you would be very, very ill-advised to go against that. If suddenly you saw that going up on increasing volume and down, decreasing on down volume, then you'd be very, very ill-advised to go short, because that's bullish volume. And you check it out for yourself. I don't think you'll get anywhere else in the world, apart from analyzing the daily chart directly, as more help to you as a trader than this chart.
So you can hear the teacups going. So it and a slight pause. Thomas says, can you use KG on any time frame? Yes, you can, but we don't have that facility in our software at the moment. So I don't see any other questions on the screen, but we did mention, I know someone, actually Tom's, apparently Gavin's going to look at gold later today, but shall we have a look at it now? Because Tom's interested in having a look, as we've only got the daily chart, but we'll have a look at, oh, well, yeah, of course. So today, I'm going to ask you again, Jamie, at what point is gold now at? What price? I know you did put it in, but I delete the questions. Jerry says, does Spot Forex use KG charts? Well, Pete, does Spot Forex? End of day is the only facility that has KG.
You see, I had that KG chart put in by the programmer. I believe it was about 15 years ago, right? And at the time, see, don't forget, I'm learning as we go along all the time myself. At the time, I didn't realize how important it was, because there was other issues, you know, with signals and one thing and another. So I tended to put it a little bit on the back burner, right? And that's why it's not on the intraday. Now, Gavin has all this information, but he's unable to get the programmers at the moment to do it. I mean, I've had, over the last 20 years or less, I've had about 20 programmers trying to work for me. Now, these are skilled, clever guys. You ring up the university, you talk to the computer plate people, and you tell them you want somebody to help you. And the teacher usually picks out what he or she thinks is the best one. And they come along, and they sit there, right, and they may even work for you for 8 months. You're paying them all the time. But not one of them could get their head around it and not program it in the way I wanted it so it works. So there's a problem there. Now, why that is, well, there you are. I suppose programmers come in different levels of expertise. But that was my experience. So when you're up against things like that, you tend to concentrate on the things they can do or you can do.
I asked what price gold is at the moment, and Edmund is saying 1504, and Thomas 1503. Peter's sitting here in complete utter disbelief that it is. So, is it? He's saying, "Are you sure it's not 1540 instead of 15?" So, Tom, I'll have to bring up just a few more, just to show you. Crikey, where it is. We can't. Well, it's right down. It's Tom. I'll go back to. It's. Well, yesterday it closed at 1564, Tom, and it's now 15. Oh gosh! And Philip's saying gold dipped below 1500. So it closed yesterday 1565. It's now 1500. So what's that? 65. So it's really plummeted. Have you got anything to say there, Tom?
Well, unfortunately, I mean, I looked at gold chart the other day, and to me it looked reasonably strong. So if it's plummeted down today, right, there's a possibility it could be a shakeout. That's why I've never traded gold. And I don't like gold, to be quite honest, because it's packed full of amateur traders. And they could be taken for a ride fairly easily. Where we showed you commodities, haven't we, like gold and things, not gold, cotton and things, and how they run according to, principles. But this gold, because it's full of these amateurs busy trading away, right, they can whipsaw, but there's always a possibility of a shakeout. I looked at gold a few days ago, as I said, and to me it looked like some sort of support, little bit of support was coming in. But I don't religiously follow it. Gavin seems to like it.
So Philip's saying here, a huge background weakness and a push down through important level of support, but there was some panic, so it could be a shakeout. We need to wait to see the close of the bar and the volume. Extremely good advice there from Philip. Can we put this up as a KG chart? So a few people are asking that, just to have a look. Do you want to comment? Oh look, there was... Yes. Oh, isn't it? Oh no, that's green.
Well, it's quite possible. You've got to keep this in mind. It could be a shakeout. And especially if it's Friday. They love to that, and they'll keep it low. So all over the weekend, you'll get bad news coming out on the newspapers and magazines, and of course the money programs on TV. But I looked at this chart a few days ago, and to me it looked like some support was coming in. And that's portrayed with this green area, look. Although there's some red there. Although I must admit I can't see it all that well. Okay? But it's a subject that if you're going to trade gold, it looks as if you need to study that and nothing else. you've got all different time frames, and that way you become a professional trader eventually.
Leonard is asking, how do you set up the reversal for KG? Do you know what that's about, Tonka? Peter and I don't know. Do you know how do you set up a reversal for the KG chart? Well, Peter and I have no idea about that. I mean, up here, Tom, is a box here it says reversals. Can you remember what that was about when it was programmed?
Daily chart, see what happens.
Right. Yeah. You have to look at the daily chart to see what happened. Yeah.
Well, the top reversal is a sign of weakness, and usually get a fairly decent, healthy, widespread up, close near the high. Pardon? And then next bar, or next time it goes down, so widespread down, close lower than the low of the previous bar. That's normally a top reversal, which is a sign of weakness.
Okay. Jerry says, Tom, how many years did it take you to get your head around the chart reading before you were consistent? This will give us some perspective as we learn to become professional traders.
Well, to be quite honest, initially when I started with the syndicate, I didn't know what on earth was going on, quite honest. I've started from scratch. I didn't know anything at all about markets. But because it sounded very interesting, I was thrown right in the middle of them. I thought it was a good opportunity to try to pick something up. It took 2 years for me to even start getting a grip on it. Because don't forget, these professional traders, they're not good helpers, right? They're just not good at it. You know, they're so busy doing their own thing here. And they don't suddenly stop and say, oh, come on, Tom, I'm going to teach you. They don't do that. It's every man for himself, and you have to concentrate. I only started getting some idea when I took the course from SMI. They were in Park Ridge, Chicago at the time, and they paid for the course, Wyckoff course, $500, I think it was. And I studied that, absolute concentration, and then I started to get some idea what was going on. But what really got me, shall we say, good, was when I decided to have it computerized. Now, it's all very well having knowledge of something, but to portray it and tell it to a computer, because the computers just don't understand. If you get the slightest thing wrong, they don't want to know. And therefore, there's a lot of trial and error. And there were several years of persevering with that. Right? And of course, the programmers don't know anything. They're just doing what you tell them to do. And, you know, I had one programmer, and he shook his head and said, well, this can't work. You can't expect that to work. He said, there's too many variations in the data. You know, they speak in this very intelligent way. And it sounds good. So you're up against that, all sorts of things. But there are, if you persevere. Now, there's been a lot of people trying to copy this program, but there's been nobody that's yet successfully done it. And for that reason, the computer does not understand flaws in your thinking. You've got to get it dead right or not right at all. Or if you get it wrong, the signals are all crazy. They talk about these add-ons, right? Now, I've never seen an add-on. Gavin's got these programmers that do these things, right? I've never been shown one. I've never been asked, does that look all right? Ever. Now, why that is, you have to ask Gavin. So I've never been able to check them out. And I'm sure that they're not anywhere near as I'd like them.
Okay, well, we've run out of time now. Just a few things here. Thank you, Colin, for talking about that, about my blog. Thank you. And is there any particular reason why I chose a DAO? I don't know. It's a historical thing. When we were looking, just learning and studying and making all our mistakes, my husband just said to me, the DAO looks really good, and I think I found that the DAO was quite reliable on the signals that I was seeing, and that's why I just stuck to it and got to know its behaviour, and I feel more comfortable with just the DAO. Maybe in time, John wants to know the address of it, the blog. I'll put that in a minute. Philip had just like to say, Philip says I should just add, because you heard us mention Philip's comments, Philip Friston, I should just add I look at the futures, not the ETF, so my chart may differ from Tom's. Okay, thank you, Philip. Carlos says, interestingly enough, with the settings on NinjaTrader, gold looked very weak last week with big red volume bar on the KG chart. That was on NinjaTrader, so there you go. Study the charts. Okay, fine, good. Okay, we'll see you all. Oh, well, yeah, you, Tom. Tom's got something to say. Say goodbye.
What? Yeah, we've got a sign of weakness. Yeah, look at this. We're going to put 30 minutes out. Now that looks weak. You certainly wouldn't want to be long or go long when you see those black bars like that with a signal on it as well. Up thrust. Now, there'd be a lot of trial and error doing those signals, and I'm always saying to Gavi, ignore the signals at your peril. Right? That looks like a sign of weakness. So, and also we're expecting those lower, if the market's bullish, we're expecting those lower levels, if the market gets down there, to show low activity, if it's bullish. Okay, but that definitely looks weak. So I'll leave you with that, and I'll say thank you very, very much for listening. And I'll be doing the newsletter Saturday or Sunday with Rita. Rita kindly types it out. Sunday. Rita saying Sunday. She's looking after her dog. if you want to know the real reason. And I say thank you very, very much. And I'll say good night.
Welcome to GoToWebinar, Web Events Made Easy.